What's up, everybody? This is Sunko, the Korean Bro. Today is 2023, August 3rd. And let's see. Okay? Hmm. Okay. Hmm. A bull market is coming, one growth stock that could surge when the economy turns. Is it too late to buy PayPal stock? Hmm. Okay. GXO. Just marked 2 full years as a publicly traded company, the logistics services provider has come a long way since it was spun off from XPO in 2021. The logic behind the spin-off was that it would unlock shareholder value and allow each company to more easily pursue mergers and acquisitions, allocate capital, and compensate company employees as a pure play focused on one industry. Okay, GXO. PayPal posted a mixed second quarter earnings report. It lost active accounts for a second consecutive quarter. Its free cash flow turned negative. CEO will leave at the end of the year, but the company hasn't named a successor yet. The fintech leader still can't impress the bulls. PayPal's stock plunged 12% on August 3rd after the digital payments leader posted its second quarter earnings report. Its revenue rose 7% year over year to $7.29 billion. Hmm. Just narrowly beating analyst estimates, its adjusted earnings grew 24% to $1.16 per share and matched the consensus forecast. Those headline numbers weren't disastrous, but a deeper dive exposes a few red flags. Those headline numbers weren't disastrous, but deeper dive exposes a few red flags. Let's review those issues and see if it's too late to bet on PayPal's turnaround. Hmm. Okay, it's losing active accounts as its free cash flow turns negative. PayPal ended its second quarter with 431 million active accounts. Hmm. Oh. The losing active account as its free cash flow turns negative. PayPal ended second quarter with 431 million active accounts, but that marked its second consecutive loss of accounts on a sequential basis. Its free cash flow also came in at negative $350 million compared to positive $1.3 billion a year ago. Hmm. Okay. PayPal didn't directly address the loss of active accounts during its earnings call, but it was likely caused by slower e-commerce sales in a post-pandemic market, inflationary headwinds affecting consumer spending, and competition from other payments platforms. Its final decoupling from eBay likely exacerbated that slowdown. On the bright side, PayPal's payment transactions per active account also grew 3% sequentially and 12% year over year during the quarter, which offsets loss of active accounts and boosts its total revenue. Therefore, PayPal will likely face more pressure to monetize its existing users with higher fees or new services if it continues to bleed active accounts. That's why PayPal expanded its ecosystem with buy now, pay later options, cryptocurrency purchases, and deeper partnerships with credit card companies like Visa and MasterCard. It's also been adding in store payments to its peer to peer payments app Venmo. Unfortunately, none of those new features are significantly boosting its total revenue yet. For the third quarter, PayPal expect its revenue to rise about 8% year over year. That would merely match its 8% growth in 2022 and compare poorly to its 18% growth in 2021. As for its FCF, it turned negative because the company set aside $1.2 billion during the quarter to pay off some beta launch. However, it expects the sale of its European BNPL launch later this year to offset the decline and drive it toward its goal of generating $5 billion in FCF for the full year. Focusing on its operating margins and earnings growth. As PayPal's growth cools off, it's cutting costs to stabilize its adjusted operating margins. It's also repurchased about 6% of its shares since the end of 2021, and it plans to spend all of its FCF this year on additional buybacks. That's why its adjusted operating margin expected by 228 basis points year over year in the second quarter, while its adjusted EPS growth outpaced revenue growth for the third consecutive quarter. For the full year, hmm, PayPal expect its adjusted operating margin to expand by at least 100 basis points from a 21.3% in 2022, but that would still be significantly lower than the 24.8% and 25.1% it posted in 2021 and 2020. Its low valuation reflects its uncertain future. PayPal stock looks historically cheap at its 13 times forward earnings, but that low valuation reflects its uncertain future. CEO Dan Schulman, who has led the company since its spin-off from eBay in 2015, will retire at the end of the year. The board hasn't named a successor yet, and it's unclear if the next CEO will follow Schulman's lead on cutting costs and buyback stock, or sacrifice its near-term margins to aggressively court users, expand its ecosystem, and widen its moats. Without a clear roadmap, investors are left with a company that is losing active accounts, struggling to differentiate itself from its competitors, and facing tough macro headwinds. So for now, investors should avoid PayPal until it appoints a new leader, lays out clear plans for its future, and shows they can keep growing in this tough market. So you have to wait till it appoints a new leader. Um, Current leader named Dan Schulman will retire at the end of this year, and they haven't decided next successor yet. So it's everything is not clear, mm, including how the new leader will lead uh, the market and how he or she uh, will do about its struggling condition, stuff like that. Mm, Everything is not clear. Okay, three stocks we plan to hold for August 6th. Okay, let's start reading about these companies will likely not give shareholders any reason to sell. Saying you will never sell a stock is exceptionally bold. Realistically, no investors can make that absolute guarantee as anything can happen to a company over the long term. However, a few stocks have kept themselves relevant for several decades and continue to prosper. Others lack that decade long track record, but are on track to maintain growth over the long term. Given the state of their business, market positions, and financial conditions, we see this level of potential in stocks like Visa, Roku, and Shopify. Visa. Okay, Roku's renewed growth could be a sign of things to come. Streaming isn't a new topic on Wall Street, but it's still not plenty of trades left on the tire. Roku's been there since streaming early days, steadily accumulating a user base of more than 73 million accounts. Today's Roku's business is built on advertising, selling ads to millions of eyeballs that stream through Roku branded televisions and streaming dongles. You know, Hmm. Advertising is reported within Roku's platform segment approximately 88% of the company's revenue. The stock had a tough 2022 when the bear market cooled investor sentiment and recession fears spooked advertisers into pulling back their ad spending, snuffing out Roku's revenue growth. However, improving economic sentiment sparked renewed revenue growth in Roku's second quarter. Economic sentiment sparked renewed revenue growth in Roku's second quarter. Improving economic sentiment sparked renewed revenue growth in Roku's second quarter. Okay. Hmm. There, there should also be plenty of room for long-term growth. In the United States, streaming is still just over a third of all television viewing. More than half of viewing is still broadcast and cable feeds. It's still just over a third of all television viewing. More than half of viewing is still broadcast and cable feeds. Roku is also an international company pursuing user growth in foreign countries. Roku branded TVs are number one in Mexico, and the company just expanded to other parts of Central America. Roku also has developed streaming ads where consumers can purchase directly through an ad using payment information saved in Roku. These innovations and continued user growth made Roku a potential multi-decade winner. This fool plans on holding his shares for as long as Roku's steady worldwide growth continues. Although Shopify stock is only traded on the market since 2015, it has already shown signs of a maturing company still capable of rapid growth. Yes. The e-commerce company sports a market cap of $86 billion, making it the largest company in Canada that is not a bank. Hmm. Also, Shopify has become the number one e-commerce platform in the US, according to Built With, uh, and remains the top e-commerce site globally. Moreover, with the stated goal of becoming a 100-year company, it seeks to balance growth with profitability and maintains an investment portfolio with different time horizons. Another factor that could support this is the longevity and extensive ecosystem. This goes beyond the flexible and easy to use sales platform that companies can tailor to get a desired appearance. With a stated goal of becoming a 100-year company, seeks to balance growth with profitability and maintains an investment portfolio with different time horizons. It also includes an investment that supports functions such as raising capital, managing payments, and monitoring inventory that sells both online and offline. This added functionality makes Shopify easier to use and increase the likelihood that other merchants will choose its platform over Shopify's numerous competitors. Furthermore, since it decided not to exit the fulfillment business, its financials have improved quickly. In the first half of 2023, its revenue of $3.2 billion increased by 28% compared with the same period in 2022. Additionally, when taking out one-time charges related to the sales of the logistics business and other factors, when taking out one-time charges related to the sale of the logistic business and other factors, the adjusted net income for the first 6 months of the year was $190 million, reversing the adjusted net loss during the first half of 2022. Consequently, Shopify stock has risen by almost approximately 80% this year. Although its price to sales ratio of 14 has recently grown, it remains cheaper than 2021 levels when Shopify routinely sold for more than 40 times sales. Given these results, it should bode well for the e-commerce industry and by extension Shopify shareholders as more merchants expand their online presence. Um, Let's look at Confluent. Okay, Confluent. Mm, what stock is Confluent? Confluent just reported its financial results for the second quarter of 2023. The company's revenue came in above forecast for a ninth consecutive quarter. Wall Street has taken notice of Confluent's performance, and analysts are overwhelmingly bullish on its stock. The U.S. corporate world is currently in the middle of an important reporting season for the quarter ended June 3rd. Uh, Data streaming is a similar concept. Companies have always collected the data on their customers and on their operations, but they used to store it on a physical server on site, analyze it in a later date. Companies have always collected data on their customers and on their operations, but they used to store it on a physical server on site, analyze it a later date. But thanks to data centers and cloud computing, they can now rent powerful infrastructure at a fraction of the cost. Um, and thanks to data streaming platforms like Confluent, their data can be ingested by the data center, processed, and analyzed in real time. It allows companies to draw immediate insights on customer behavior or operational processes, which helps saves on cost and maximize revenue. Take retail giant Walmart. For example, it uses conference data streaming platform to manage inventory in real time. It connects all stores across the US with its online sales channels. So each time a product is purchased through any means, inventory is updated live. That means there is practically no reason for a product to ever run out of stock because Walmart knows exactly when to replenish it before the shelves run empty. That elevates the customer experience and ensures that people are always up to date on what's available and at which locations. Confluent delivered another blockbuster quarter. Confluent. Let's look at Confluent. Hmm, okay. Wall Street is overwhelmingly bullish in Confluent stock. Many technology companies are struggling to generate growth in this economic environment. Some are even slashing their forecast. That places Confluent among a unique group of resilient business investors can rely on to perform during tough periods. It's not surprising the Confluent stock jumped 9% immediately following the release of its quarter second results, but it's still down 61% from its all-time high. That presents an opportunity for investors to buy now, especially given that the company has a long runway for growth with an estimated addressable market worth $60 billion today. The Wall Street Journal tracks 25 analysts covering Confluent stock. 15 of them have given it the highest possible buy rating, with one in the overweight camp and the remaining nine recommended holding. Not a single analyst recommends selling. Hmm. Okay, Confluent. Uh, okay, let's read this article. M2. What is M2? You know, a 2% or greater decline in M2 money supply, which has only occurred four previous times in 153 years, has historically been a harbinger of bad news for Wall Street. Following the money leads to other concerning economic data points. Money supply since the Great Depression is typically accompanied by a big move in stocks. The last time M2 money supply contracted by at least 2% was 1933. Over the long run, Wall Street is a money machine for patient investors. But when examined over a period of months or perhaps a year or two, the stock market can truly be a riddle wrapped in a mystery inside an enigma, to quote the late Winston Churchill. Already trailing towards the iconic Dow Jones Industrial Average, surged all-time closing highs, plummeted into a bear market, and have now rocketed out of the gate in 2023 into what some investors would deem as a new bull market. Hmm. And when Wall Street gets whipshot, investors often turn to an assortment of economic data points, probability tools, and other metrics to offer. Clues as to which direction stocks will head next? Hmm. Okay, next one. It gets a bit complicated. Once I know what M2 is, I'll explain them in detail later next time. Hmm. New kind of Starbucks in town. Yeah, let's invest where young people are spending more time. Okay. This popular gaming platform is starting to see growth to re-accelerate after sluggish 2022. Over the last 4 quarters, bookings has improved from a decline of 3% last year over year, to an increase of 23%, and a rebound in growth across the gaming industry could spell more upside for the stock. Roblox has emerged as one of the most popular platforms where young people hang out with friends in a virtual environment and play games, among other activities. Even when bookings flattened out last year, the platform never stopped growing amid the challenging macroeconomic environment. Growth in daily active users never dipped lower than 19% in the fourth quarter of 2022, before accelerating to 22% in the first quarter. The continued growth in the platform will only strengthen Roblox and position it for more success. Management has been investing all its revenue into new features, developer fees, and data center infrastructure, research and development expenses. All its revenues into new features, developer fees, data center infrastructure, and research and development expenses. Management credited the investment in expanding its product development teams for accelerating growth entering the year. With many of these investments behind the company now, management expects bookings to grow faster than expenses for hiring and compensation. As a result, investors should look for growing free cash flow to push the stock higher over the next few years. Okay. Now, what Marco Deliberate. One stock I watched closely this earnings season is Marco Deliberate, a leading e-commerce platform in Latin America. Following in the footsteps of Amazon, Marco Deliberate has grown from a first-party direct online retailer to a diversified e-commerce empire with large marketplace logistics unit, burgeoning advertising business, and finance arm, and most importantly, its digital payments platform. Mercado Pago, which now primarily services payments off Mercado Libre's platform, including a brick and mortar retailer store through its mobile point of sales devices. While most of the global e-commerce industry has been challenged by slowing growth following the pandemic era boom, Mercado Libre has bucked the trend, posting strong results in its second quarter earnings report. Mercado Libre reported a 57% increase in the currency neutral revenue to $3.4 billion, with gross merchandise volume up 47% to $10.5 billion, and total payment volume nearly doubling, up 97% to $42.1 billion. Even better, Market Libre's profitability continues to expand thanks to growth in higher margins such as its marketplace, digital payments, advertising. Income from operations more than doubled from a $250 million to $558 million in the quarter, as Market Libre is investing further in profit drivers like advertising. Mercury Libre has also fended off competition from challengers like Amazon and Sea Limited, which have recently been more focused on cutting costs in their e-commerce divisions to deliver profits. As the Latin American middle class continues to expand, Mercury Libre has large growth opportunity ahead of it, and e-commerce stock could jump further if it can keep reporting strong numbers in future quarters. Let's read. Let's read this one, and that's it for today. Okay. The last article that I'm going to read is about the company named Microsoft. Oh. A bull market is coming. One magnificent artificial intelligence. Uh, After, uh, okay. Well, after ending enduring its worst plunge since 2008, Microsoft. Let's look at Microsoft price, stock price. Okay, is at least partially responsible unprecedented expansion. Okay. Unprecedented expansion. That's how IDC described the PC market during the early days of the pandemic as working from home, widespread lockdowns, and strong adoption of computer games have driven demand for computers not seen in years. However, a saturated market and the onset of economic challenges combined to bring that growth to a screaming halt. The average PC has a lifespan of about 3 years, so IDC expect growth to stabilize with shipment volumes reaching pre-pandemic levels at some point already next year. During Microsoft fiscal 2023 ended June 30, revenue in the more personal computing segment, which included Windows operating systems, personal devices, Search and news advertising gaming declined to $54.7 billion, down 9%, offsetting gains from its other business segments. A recovery in the PC market will remove the headwind from Microsoft's results, which could propel the stock higher. Microsoft is at least partially responsible for kicking off the current artificial intelligence revolution. The company was among the first to recognize the potential implications of generative AI, making a $13 billion investment in OpenAI soon after it started releasing ChatGPT. Since then, Microsoft has infused AI into a broad cross-section of its products and services, and the impact on its financial results could be significant. Billionaire Dan Loeb of hedge fund Third Point posits the Microsoft AI assistant office Copilot could increase the company's revenue by $25 billion or more in software sales alone. There are still plenty of as yet undiscovered ways for Microsoft to profit from AI, limited only to the company's imagination. The company could leverage its AI expertise to attract converts to its cloud solutions, which will be rife with their productivity enhancing potential. The company offers strong exposure to software as service and cloud computing, with AI thrown in for good measure. Add to that the expected rebound in the PC industry, and you can see the growth opportunities begin to mount. Yet, for all the potential, Microsoft stock is still relatively cheap, selling for just 11 times sales and 9 times next year's sales, which I submit is a bargain when stacked against the company's growth potential. Okay, this is it for today, and I'll see you guys tomorrow, okay? Bye bye.